Thanks for joining us. We're back now with David Rosenberg, chief economist and strategist with Gluskin Sheff Associates. And David, you talked about the timeline that the White House has put in place to get a trade deal done. With all of its trade tactics, a lot of people have said the Trump administration has a healthy U.S. economy in its corner. It has the advantage of its heft and a decent performance for the U.S. recently to take this tone. How would you describe what's happening with the U.S. economy right now?
Well, maybe it's an absolutely brilliant strategy to embark on an epic borrowing in the debt markets by Uncle Sam to finance a huge tax cut at the peak of the cycle, buy some growth, so then you can beat up on your trading partners. Maybe that's a brilliant strategy. I hear all the time how great the U.S. economy is doing. Look, it is a complete mirage. 4.2% growth in the second quarter. Do you really believe that? Strip out the stimulus from the tax cut, which is not a perpetual source of growth, and it was more like 2%. And we're taking a look in the third quarter. You got the Atlanta Fed, which is 4.6% for the third quarter in its estimate. You got the New York Fed almost at 1.9%. You can drive a Mack truck through those two estimates. But the Atlanta Fed, everybody focuses on, is just littered with survey data. I expect that number is going to come down materially. So I think that the U.S. economy probably saw its peak growth in the second quarter. I think things are going to slow down sequentially. And I think recession risks for next year are far higher than practically any asset class has priced in right now. Well,
you're making those comments at a time when we're talking about the S&P and the NASDAQ at record levels. How do you think that'll impact the stock market?
Well, if I remember correctly, the stock market hit an all-time high back then in October 2007. The recession was a couple of months away. I don't even know, really, is the stock market really telling you anything about the economy? What has been the most important underpinning for the stock market has been the stock buyback craze. You've got the share count in the S&P 500 down to its lowest level in 2 decades. You've had this M&A craze, massive stock buybacks. What's interesting is that yesterday we got the second round of the U.S. GDP data for the second quarter. So we got the national account profit numbers, which is profits for the entire economy, not just the S&P 500, which is a subset. And what's interesting is that for all the talk of there being 25% year-over-year profit growth, which of course earnings per share in the SPX, when you look at the economy-wide profits and you adjust for the tax cuts, tax expense is down 33% in the past year. How could corporate profits not be up? But when you adjust for the tax cut and you adjust for the wonderful generous depreciation allowances, earnings growth in the economy, corporate earnings growth in the United States, I looked at the numbers, is running at 0.2%. So I think this is a classic case of the equity market almost acting like a commodity now. You do have these relentless, almost blind inflows into ETFs. You wonder if people actually know what they're buying. But the real underpinning has been the fact that the share count has come down so much. And that's given the real lift to the equity market. I'm not even sure it's giving you a real read on the economy. In fact, if you're taking a look at the leadership in the past little while, in this latest up leg to the highs, what's interesting is that it's been the defensive sectors, like healthcare, like telecom, like staples. That's the stuff you sort of want to own on a sector basis when things start to slow down in the economy. So the stock market may actually be giving you the same growth signal that the bond market is right now.
That's what I was going to ask you. We're out of time, David, but you're saying that if that's your view, your thoughts on how to play the markets today would be play defensively.
I definitely would be very selective, and I would certainly start to shed the cyclicality in the portfolio, the economic sensitivity, that much is for sure.
David, always good to get your take. Thanks so much for joining us this morning. David Rosenberg, chief economist and strategist at Gluskin Sheff Associates, joining us from the TSX.